Good morning, and to our friends joining us abroad, good evening. Welcome to Merage Talks. Today we welcome Bruce Entin. You touch on the topic Investor Relations 101, telling your story to Wall Street. Bruce, thank you so much for joining us today. Let's get started.
Okay, thank you. And thank you to the Merage Institute for the opportunity to present today. This is about telling your story to Wall Street, but the reality is, for whether you're an entrepreneur telling your story to seed investors, to venture capitalists, to strategic investors, it's really one and the same. So this is really intended for first-time CEOs, for perhaps CEOs who have already told their stories to Wall Street, but want to learn and refine their skills at doing so. I think the key for especially a young company is to position themselves as a large company that just happens to be small at this particular moment. And what that means is understanding what investors all the way along the food chain, from seed capital through IPO and secondary offerings, what they need to understand. And I can tell you, and I'll show you, that the world of investing is changing dramatically in real time through things like environmental, social, and governmental regulations, as well as pressures from large investors. So the good news, especially for Israeli entrepreneurs, is you have good role models. There are already almost 80 companies that have gone public on NASDAQ, 38 in healthcare, 24 tech companies, 7 capital goods companies. So it really doesn't matter if you're technology, if you're in software, if you're in hardware, if you're in biotech, artificial intelligence. It really doesn't, you need to have those things squared away. You need to understand your market, you need to understand your customers, but you also need to understand your investors. And the good news is that there's only 3 countries rather, that are listed on NASDAQ, and that happens to be China, the US, and Israel. Those are the 3 main countries. So, and in just the first half of this year, Israeli companies have had mega capital raises, 30 in the first half of the year as compared to 20 over all of 2020. So Israeli companies obviously have a lot of experience in this. For those who don't, this presentation is intended to help give you some tools to do that. So just a little bit of background on me. I position myself as a storyteller, and that's what you in the C-suite in your companies need to be as well. I started out as a technology journalist at the San Jose Mercury News, covering semiconductors, all technology back in the early 1980s, when semiconductors, and in particular, was not the worldwide force that it is now. It was really between Japan and the US. I joined Atari as head of communications and spent 17 years at LSI Logic, a chip company, doing investor relations, being promoted to run all of marketing, running product groups with P&Ls, was a CEO of an Israeli startup, actually, and spent 15 years consulting in investor relations. So the agenda today is I want to give you a sense of what the current situation is today in a COVID world. And we're going to spend some time talking about this environmental, social, and governance, because you really do ignore this at your own risk. Venture capitalists are going to be interested in this. Wall Street investors are going to be interested. And in fact, your customers and your supply chain are going to be interested in this as well. And I'm going to cover some do's and don'ts, some traps that you should avoid as investors dealing with investors. I'm going to give you a case study and talk about investor relations surveys, which is a third-party way to really unearth what investors are really thinking about your company. Talking about Reg FD, which is a fair disclosure. The Wild West of the old way of doing investor relations and communicating your story has changed forever. And just parting words to CEOs and to C-suite to be confident and to be careful. So for the last almost 2 years now, we've been dealing with COVID, and it has shut down really the global marketplace for most of 2020. And in that environment, in this ecosystem that we're dealing with, investors have actually been not just encouraged, but told by the Securities and Exchange Commission that when they report their earnings and when they talk to investors, they must share what they're doing about COVID in terms of supply chain, in terms of employees, in terms of impact on earnings. Just one example, during 2020 in April, Jeff Bezos said in a press release, was very upfront and showing a paper trail, said, if you're a share owner, you may want to take a seat because we're not thinking small. And in fact, their goal was to spend all of the profits for the next quarter on mitigating COVID impact on their business, including testing, including retrofitting warehouses, fulfillment centers. Every aspect of the business was changed. And as a result of SEC guidance on what to do about telling your story to Wall Street. So against this backdrop, there are a lot of changes happening. The travel, the tourism industry, restaurants, cruise ships, all took a dive in 2020 and early 2021. Office space was hit hard as people were working from home. But that working from home had other impacts. E-commerce jumped in 2020. Lumber prices rose as people were doing more landscaping projects and home improvement projects. Biotech firms like Pfizer and Moderna, which may have been on the sleepy side before 2020, were thrust into the spotlight. In fact, Moderna is the best performing stock in the S&P 500 this year, having gone up 267% so far. What else is happening that's affecting how we tell our story to Wall Street? Antitrust fears have been all around us, whether it's Apple with the App Store, Amazon with the way that they handle third-party sellers. And just this past week, the FTC, Federal Trade Commission, redid an antitrust suit against Facebook. So the entire FANG universe, the Facebook, Apple, Amazon, Google, and even Netflix are under attack by government agencies. Cryptocurrencies, Bitcoin, Ethereum, Dogecoin, you're competing against all of those cryptocurrencies for attention. So again, how we tell the story is going to be very important. Unlikely that you're going to be a Reddit-driven meme stock like Bed Bath & Beyond or AMC Theaters, but or GameStop, for instance. But again, those stocks are gathering attention from retail investors, and it's been compared to almost a social uprising on social media, which is affecting all of Wall Street. Special purpose acquisition companies have raised over $100 billion this year in the first half of the year. These companies are buying small companies. They're basically shell companies and taking them public. There's a lot of competition for your dollars. BDS, the boycott, divest, sanction issue is something that Israeli companies in particular need to pay attention to, because that's going to affect investment decisions. We've seen how Black Lives Matter affects all companies, especially in the US, in terms of telling their investors, telling the public, telling their employees how they feel about these issues. Voting rights in Georgia and Texas, anywhere in the US, has put pressure on US companies and forced them to alter their messaging. The China crackdown on firms, we've seen it with Alibaba, we've seen it with Tencent. This will create opportunities potentially for Israeli companies, for US companies, for international companies, because investors suddenly have fear of Chinese, especially internet companies. Trade tensions between the US in particular and Huawei create issues as well as create opportunities. And finally, cybersecurity and ransomware and disclosures and how you deal with these issues with investors is critical. And finally, as I mentioned, environmental, social, and corporate governance will change the way you tell your story to Wall Street. Let's get into this and spend a few minutes on this, because even though you may be a small company now, again, I really urge you to think big and to incorporate the kinds of things that we're talking about today into your messaging so that you basically won't have growing pains to get to where you want to be later in your growth cycle. Israeli firms have actually done a pretty good job on participating in disclosures around ESG. You can see there is something around 160 companies in Israel that have already agreed to certain disclosure standards. It went down slightly in 2020, but the overall trend is up. And we've already seen that there's a correlation between companies that do a good job in disclosure for ESG and attracting international investments, primarily from the US and Europe. So there's a payoff to ESG. This isn't just being a good citizen. It's not just being mindful of the world around us. There's a direct correlation between ESG and investments in your company. There are funds that are specifically created to attract investor money to invest in companies with good environmental, social, and governance practices, as well as disclosure. So in April of 2021, this is pretty recent, the Israeli Securities Authority actually released recommendations regarding ESG reporting for publishing on an annual basis. So in the US, the federal government has worked hard to do clean energy regulations. There's legislation now before Congress to do that, but companies are not waiting for governments to act. Companies are reacting to investors. For example, Exxon, which is in the petroleum business, lost 3 board seats to a company called Engine Number 9, which spent just $30 million on an activist campaign because these activists wanted to accelerate clean energy initiatives and alternatives. And Exxon is already talking about how they want to become a carbon-free footprint going forward. So investors here have done what Exxon didn't do on its own and what government has not told it to do. Deutsche Bank announced that they're linking management pay to sustainability targets. Europe, according to Reuters, plans to funnel hundreds of billions of euros to companies that are doing sustainable businesses, and this will be done through European banks. They want a climate neutral Europe by 2050. So this is not just talk, this is money talking. Investors overseeing $4 trillion in assets are asking the biggest banks to take more aggressive action in addressing climate change and biodiversity decline. So this again is happening. This is just from July of 2021. Investors were writing to banks. They do not want banks to finance coal companies. So coal companies are going to have a hard time raising money if banks won't lend to them. So just a few other quick ones on this. This is from Bloomberg. Investment in climate technology surpassed $14 billion in the first half of 2021, greater than all of 2020. JP Morgan Asset Management and other investors managing $14 trillion in assets are calling on firms to disclose how they're going to cut greenhouse gases, and they want a specific board member to have responsibility to oversee these efforts, and they want to allow investors to vote at shareholder meetings to vote on the progress of these initiatives. Fidelity said that they will punish directors at 1,000 companies globally next year if they do not tackle climate change and boardroom gender diversity. So whether you're in startup company, mid-stage company, late-stage company, as you're looking at your board, as you're looking at your workforce, as you're looking at your carbon footprint and sustainability, this is something you need to be thinking about now. BlackRock, which is probably the largest investor in the world and the most influential in terms of board diversity and shareholder voting, right? They can influence how public shareholders vote to retain board members and on shareholder proposals, whether it's to increase a number of shares or to vote on various initiatives. BlackRock has the power to defeat a board, to defeat a company in the public's mind. This is something that they issued this year. You can read it for yourself, but they want boards to be diverse, and they want them to be diverse now. This is a direct quote from their publication. If there's insufficient progress on enhancing diversity at the board level within a reasonable time frame, and I can tell you that reasonable time frame is not 5 years, it's going to be within a year or two at the most, they're warning that they may vote against directors on the nominating committee for a lack of commitment. Walmart just issued their annual report, which is relatively new, telling the world, telling the public, telling BlackRock how they're doing in terms of board nominations, attendance of at board meetings, ethics training, code of conduct. Walmart is probably ahead of the pack, but many, many companies are signing on to this kind of disclosure. This is just from August 6th. NASDAQ had a proposal that the SEC has now backed to set minimum targets for the composition of listed companies' directors. So if any of you out there ever have the privilege of going public, your board will be a main topic of discussion with your bankers, and with the investors who decide to invest in your IPO, and for your investors who decide to invest on an ongoing basis. That's from August 6th. Today's Wall Street Journal, the SEC asked for recommendations on disclosures, not just on the board members, but on the workforce. You can see here, they want to know about your turnover at the company, skills, what kind of development training are you providing, what kind of compensation, which also includes what kind of differences are there between CEO levels, management levels, and your lower rung employee levels. Diversity, are you hiring people with different backgrounds, women's, minorities, and so on? Health and safety, again, relating not only back to COVID, but any future health issues that may arise. So the world, as far as diversity, environmental, social, and governance, is changing, and changing in a dramatic way. And I would urge, even if you're a small company now, to take all these into consideration as you consider your flight plan and your growth path. Okay, just getting down into the investor relations function, and if you're considering staffing an investor relations organization, what does it do? How does it work? We're going to get into a few nuts and bolts of that right here. So here's a little bit of a checklist. Typically, your investor relation person works to the CFO or the CFO, a CEO or CFO. It's typically a small team. In many companies, it's one person. In some companies, as they grow, it grows to maybe 2 or 3. In very large companies, it could be a little bit bigger. Why does it report to a CFO or a CEO? I told you before that an investor relation person like myself, you're a storyteller. You need to reflect what the CFO and the CEO is thinking. You need to have the trust of investors that you speak for the company. So the only way to really speak for the company is to be reflective of what the top management is thinking. You need, as an investor relations person and as your head of your company, you need to build relationships with the sell side and the buy side, as well as internally with the C-suite management. So when I say sell side, that means the brokerage firms like, for instance, JP Morgan, Morgan Stanley, Goldman Sachs, a whole host of smaller ones called Needham and Oppenheimer. They're called sell side because they're selling their research to the buy side. The buy side are people buying the research. These are people and taking recommendations. These are people like Fidelity, like BlackRock, like State Street, like T. Rowe Price, for instance. So CEOs, CFOs, investor relations people are all building relationships with these outside forces that will dramatically influence your stock price and perception. I said that you're a storyteller in chief as the investor relations person, but the reality is that the CEO and the CFO, these are the communicators in chief, not the storytellers. The investors want to hear from you most often, but investor relations people need to manage your time and manage your visibility with the sell side and with the buy side. So they're going to be managing this. They're going to be the ones telling your story. A good investor relations person is knowledgeable about the company, knowledgeable about the market that you're in, understand the competitors, understand the current events that's happening in the industry and with your company. Sometimes there's a C-suite departure, sometimes for personal reasons, sometimes for a difference in approach and a difference for strategy. Investor relations people need to manage that story, and the only way they can do that is to be very, very close to the people running the company. On a day-to-day basis, investor relations people are crafting your messages. They're targeting the shareholders. Are there shareholders that own our competitors but don't own us? Are there shareholders that are not as sophisticated and don't understand the technology that we want to avoid? Are there shareholders that are more short-term oriented that we really are not interested in because they are more momentum players? These are all things that investor relations people need to be aware of. A good investor relations person, and frankly, a good CEO, CFO, head of marketing will want to measure the effectiveness of this. I'll get into this in a little bit later, but there's many, many different ways to measure IR effectiveness. It could be in terms of number of meetings you have, in terms of the outcome of those meetings, the number of brokerage conferences that you attend, and so on. The ability to penetrate different geographic markets. There may be shareholders in Europe that you're targeting. What was your hit rate on that? A key element of investor relations is the earnings call. This is your quarterly report card. Investors will pay you for the journey. You set a goal of where you want to be a year from now, 2 years from now, 5 years from now, and every quarter you have an earnings call, which is basically your report card. It's basically your progress report. These earnings calls are carefully scripted. They're not conversations. They are carefully scripted messaging that you give to investors. Sometimes they're recorded in advance to avoid mistakes. They're carefully rehearsed. The earnings call is not just rehearsed, but the Q&A is gone over multiple times with management. And so that by the time you actually get to the live earnings call, there should be no questions that are a surprise for you. Investor relations people are responsible for staging annual meetings for public companies. It could be for private companies arranging meetings with venture capitalists, or for strategics that could be investing in you down the road. Proxy and shareholder votes. If there's a public company with proposals to be voted upon, there's a lot of lobbying that goes on with companies that put recommendations out for investors to consider. So there's a lobbying element for this too. Brokerage companies like Goldman Sachs, like Morgan Stanley, like JP Morgan, host multiple conferences every year. Before COVID, these were in person, typically in New York, sometimes in the Bay Area, in San Francisco, if it was a technology conference. But today, these conferences are being done primarily by Zoom, and companies present, and it's a good way to get your message out to multiple investors at one time. It's a great way to manage your time. There's also something called NDRs, which are non-deal roadshows. When you do a roadshow, you're basically on an IPO roadshow, you're marketing the company for the first time to investors who have an opportunity to invest when you go public. You also have opportunities to invest down the road if you're raising money in what's called a secondary offering, where you're selling new stock to perhaps the same investors, perhaps new investors. And you may be even doing these non-deal roadshows to investors who just want to learn more about the company and who are potential investors. These are typically done where one of the analysts who follow your company, one of these sell-side analysts, take you out for a few days at a time. They may arrange a lunch with a few shareholders. They may literally take you around in non-COVID times to, you might go to Fidelity and see an individual there, spend an hour and a half and get in a limo and go back to New York to visit an investor at Alliance Bernstein, and spend another hour, you're basically on the road. That's why they call it a non-deal roadshow, because you're not pitching a deal, you're just pitching the company. And I think one of the key things about investor relations is you need to be visible in good times and bad. You cannot only be out there when things are good. When things are bad, it's a double-edged sword. If you want credibility, and if you want investors to believe in you, and if you want them to come back when times are better, you have to level with them when times are bad. I think Peloton did a reasonably good plan on this when they had a treadmill recall. A child was killed under a treadmill. They didn't shrink away from the story. They faced it head on. Way back when, going back into the time machine, Johnson & Johnson, when they had a scare with Tylenol, where people actually were poisoning Tylenol tablets, they changed their whole packaging. They got out in front of the story, and they built credibility with investors. So that's kind of an overview of what happens when an investor relations function is working well. So you're basically sending messages and you're receiving feedback. Not always is the feedback what you want to hear. This is just from 2020. There's a company, Synaptics, in the semiconductor space. They had an analyst day, which is frankly another job function of many investor relations people. While you have your quarterly earnings call, many companies host an annual analyst day where you have an opportunity to take investors through your 3 to 5 year roadmap, where you have management of different divisions of your company presenting and giving a deep dive on technology, on customers, on markets. So Synaptics, in this case, gave that kind of roadmap, gave that kind of story. But Oppenheimer, which is a sell-side firm, the analyst there was not impressed. They said, quote, vague clues on long-term earnings power. The path is unclear. Well, I think Synaptics got the message, because from the time of that meeting to today, the stock has almost quadrupled. You could say that the analyst was off base, didn't really understand the story. Maybe the company didn't deliver its message in the most clear way. But in any event, Synaptics, I think, changed their story, perhaps changed the underlying fundamentals below it, and as a result, has a stock that has outperformed. This is, again, going back into the time machine. Xilinx was doing an annual meeting, and Morgan Stanley gave a preview of the meeting. And basically, the advice they gave was, we want you to be as specific as possible, talk about your growth drivers. And Morgan Stanley actually said, we've been too optimistic on the stock, but we think the stock has been oversold, meaning investors have sold it off below where its fair value is. And this was a friendly analyst giving feedback again to the company to say, listen, guys, this is what you need to tell us if you want to restore confidence in the company. Xilinx recently was acquired by Advanced Micro Devices. And since this time, Xilinx has been a great success story. Sometimes you give feedback through good earnings. This is a story from just a week or two ago. Akamai, which is a cloud provider and an edge provider, came out with earnings that met and actually exceeded expectations, but no one was excited by the story for the rest of the year, for the outlook. So the story here is that good may not be good enough, because investors are always looking for catalysts. They're looking for what's going to drive the stock forward. What we did for you yesterday is not necessarily good enough for what you did and what you're going to do tomorrow and next year. As a result, Needham, which is a sell-side brokerage firm, downgraded the firm from buy to hold because it saw a limited ability for the company to really drive earnings higher, and the catalysts they just felt were not there. Here's another example from Morgan Stanley back in 2015. This is just an example. You can read this on your own, but this is an example where the company was doing everything right, but the analysts didn't see a need to get excited about the stock. They felt it was fully valued at the current value. Here, this is feedback that you don't typically see from analysts. They talked about Cisco Systems delivering, quote, a doozy of a quarter, and as a result, the analyst said we're going to stay neutral on this until we see better news ahead. So no matter what kind of feedback you give, you can expect that you're going to get generally honest feedback from Wall Street. It's the job of the investor relations person to communicate those messages and to craft those messages, but you running a company, whether you're a CEO, whether you're management at any level, it's your job to help deliver this. I can tell you that when I was running investor relations at LSI Logic, which was a $2 billion semiconductor company, management sometimes doesn't understand the pressure that's on until if an investor relations person asks you to sit in front of a meeting with an investor and to make a commitment, then you'll feel the pressure. Believe me, this is a very high pressure situation. You're graded every quarter, and it's a high stakes game. So I'm going to give you just one example of how you should deal with investors. First, when you're dealing, whether it's a VC or whether it's a strategic or whether it's a public investor, think ahead of time what you would like them to tell somebody else or what you would like them to use as a headline in their report. Use key messages to answer the question of why should I care? For each key message that you give, use proof points, statistics, and data rather than marketing hype. Bring product demos to investors at any level to bring your story to life. I worked for a company in Korea that was making display drivers for smartphones. Bringing the actual display driver really was a novelty to investors because they don't often see actual products, and it really helps you illustrate what it is you do, especially if it's very sophisticated technology. Be very disciplined in your approach. Again, it's not a conversation. Keep things simple. Avoid jargon. Don't make assumptions. And we'll go over this in a few minutes, but you're going to be asked questions from investors that you don't have to provide answers. It's not like you or I sitting in a room and you ask me a question and I answer you yes or no. You should view every question as an opportunity to come back to the key messages that you want to deliver. And at the end of a meeting, you should summarize your key messages so that you feel good that at least no matter what happened during the rest of the meeting, your story got across. Investors will ask you questions again that will try to corner you. And you should not ever feel cornered in an investor meeting. Somebody asks you something about revenues, you don't have to say our revenues are. You can say the real issue here is, and redirect. Responses like, if I understand you correctly, I think the question is, which gives you an opportunity to reframe the question. To say, good question, here's my view. Again, not answering directly. scrolling down on this list I'm providing here, let's look at this another way. Again, not dealing directly with the way that they want the question answered. It's not avoiding, it's just making sure that you get your responses across. And I guarantee you, when you end the meeting, the investor will feel like his questions have been mostly answered, and you'll feel you've had your key messages delivered. There are many traps that investors will try to put you in. Try to rephrase something that you said so it's not exactly the way you said it. You can't let any of that stand. You have to make sure that anything that was rephrased incorrectly is corrected on the spot. Don't fall prey to silence. This is a key tactic from investors, also from reporters, by the way, who you may come across as you're positioning your company. Do not feel obligated to fill silence. Wait for a reporter, wait for an investor to ask a question, because you filling a gap, a vacuum in silence, you may say things that you weren't intending to say. Don't fall into the trap when an investor defies you or asks you or presses you to predict an outcome, like, how's the quarter going? Am I in the neighborhood? Don't think that something is over when you think the interview is over and somebody says, oh, I just have another question, or, you know what, we're done here. And then you think you're having conversation, a casual conversation, and they say, I'll walk you out of the room, or we're closing the laptop, and you think it's done. It's never done. You're always on with an investor. So just one last thing on this, I think, which is there are either or questions that never have to be either or. What's your biggest problem, your cash or your revenue growth? The loaded question, where do you go from here? You're struggling now. You don't need to answer those kind of questions. You can say things like what you see here on the screen. I think what you're asking about is our future. This gives you a perfect opportunity to talk about the messages that you want to talk about. So don't overreact. Don't be defensive. Never get emotional. Don't promise information that you can't provide. Don't repeat negatives, like when they say you can't do this, and you say, no, it's not a matter of we can't do this, because that's the kind of stuff that gets printed in reports. Don't be afraid to say, I don't know. Not everybody knows everything. And it's okay for you to say, I'll get back to you on this. Don't use the marketing hype. Again, don't feel compelled to fill the silence. Don't over answer. Less is more. If they want more, they'll ask for more. Never badmouth the competition. This is kind of hard, because it's always easy to say, we've got a better chip, we've got a better solution, we've got better software. It doesn't work. And it gets back to the competition. Your investor will think less of you for doing it. And don't ever answer something without trying to get some key point across that you've crafted ahead of time. So just an example of how not to do it. Again, this is going back in the time machine back to 2015. The CFO tells a small group of a small group of investors that while the PC data points look like it's sort of flashing a yellow light, it's still sort of in line with the company's guidance for the quarter. And the CFO highlighted the growth in the data center business. That was on February 6th. 3 days later, Cowen and company did a meeting with a number of investors and with the company management, and they walked away feeling incrementally more confident about the company's outlook. This was on February 6th. This was on February 9th. On March 12th, less than a month later, Intel reported, and they missed the number. They lowered their guidance before the market opened, and their negative revision refocused attention, according to the analysts, on the company's outlook. This was This was a mistake that the company made on its own. It was an unforced error. There was no need to overpromise. There was no need to get ahead of themselves, but they did. So that's a case study of where you should not do. I mentioned before that investors pay for the journey. This is a situation where a company ran afoul of investors. Their credibility was damaged. Their reputation was damaged. They had a restatement, which caused the whole management team to resign. This is an actual case study where a new management team came in, and it was a rookie management team. It was a company that had different divisions in different businesses, so it was very hard for investors to value them. Were they more like a cloud company, or they more like a retail company, and so on. Size, this happened to be a small market cap company. If the people listening to this happen to be in a small company, or a small market cap when they go public, that's going to create certain issues because certain investors can't invest in small market cap companies. So you're limited in how you tell your story. Analysts at these big brokerage firms that I spoke about earlier, they'll cover 15 to 20 companies. So to get your attention, to get their attention for you is difficult, especially in bad times. So this particular company only provided guidance 1 quarter at a time, didn't give visibility for a year out or 2 years out or 3 years out. And they absolutely needed to show sustained execution. 1 quarter is not going to be enough to demonstrate success and that you're over the hump. And this particular company needed to overcome something that was actually out of their control, which was the market. And so these are all things that that this company faced as they went through. So dramatic erosion of trust and credibility. Stock was hammered, new and untested management, and yet some analysts and some investors saw opportunity and they were willing to listen. So what happened? The investor relations people and the management said, okay, what kind of investors are aligned with the kind of business that we're in, that are comfortable with our business model? Are they sophisticated? Do they understand the technology? Do they understand that this is a long-term recovery story, that we need 3 years and we need patient investors? We need diversified funds that, like a T. Rowe Price, that may have a technology fund, that may have a software fund, that we could attract investors from different funds within a one umbrella of, for instance, like a T. Rowe or a BlackRock, and that have a reasonable need for management access, because you can't spend all of your time talking to investors. You've got to run a business. So you need investors who are willing to understand that you can't pick up the phone every time they call because they have a question. That's what your investor relations people are for. So what happens is a good investor relations person and a good CEO and a good management team will come up with a plan, an investor relations plan, which basically maps out what are the shareholder visits going to look like to attract new shareholders, to expand the current shareholder base, to keep the current investors in the socket. Which investor conferences are we going to go to? How many investor conferences are we going to go to? Because before all these were being done on Zoom, a lot of travel time, especially for international companies that burn a full day just to get to the US, for instance, from Israel. Are we going to do an analyst day? Where is it going to be? How many people are we going to invite? What are our key messages? So this is the kind of thing that's laid out in great detail from here in terms of what you're going to do to engage with investors. And in the case study I just gave you, all of this was done to reach existing shareholders, to reach existing analysts, and to attract a new base of people who believe in your company. This is a really quick section, investor perception surveys. If you really want to understand what investors think of your company, you do something called an investor perception survey or an investor pulse survey. This is typically where you hire an outside consultant to go talk to your investors, to go talk to your analysts who are following the company, as well as to analysts and investors who are invested and believe in your competitors, and you want to understand why they're not investing in you. This is not something that they're necessarily comfortable telling you because you control access for them. So if you have an outside person or a consultant getting an unvarnished view on a confidential basis, which is not disclosed, it's all anonymous, they'll tell a consultant things that they won't tell you as the CEO or as the CFO. I've done many of these, and I just want to give you a couple of examples of the kinds of things that they say. This was an example of a video games company that was making the transition to digital from packaged goods. And one investor said, they do a great job showing charts of how they're doing digital, but they're not showing a decline in packaged goods. So this was a call for more visibility and transparency on the earnings calls. I think one of the problems is people don't have a picture of profitability of the digital business. What does the gross margin look like in that business? This particular investor didn't think it was profitable and wanted to understand just what the outlook was for that business. Another company, investor said, what are they doing to control costs? The macro is going to do what it's going to do, but they can control their costs. This was a company I worked for. Investors were concerned because the CEO was being a little bit too bullish and too ambitious about the revenue goals not being met. And with the CEO being bullish, the analysts and investors were concerned not only that the revenue goals weren't being met, but that the operating expenses were going to be increased to meet those ambitious revenue goals. So investor surveys are an important function of investor relations. So I want to get into Reg FD really quickly. We'll move it along. Reg FD means basically that you're going to tell the same story to all investors. It's not something that you can tell one investor, by the way, where the quarter looks a little soft or a little weak. If you do something like that, you have to tell everybody at the same time. And if you make a mistake and you don't, and if you do tell somebody unintentionally, you have to come out with a public disclosure in a press release to basically tell everybody the same thing that you told that one person. This is why you see in press releases these long, legally constructed, forward-looking statements that say basically whatever we say could change. You can't hold us. You can't hold us, and you can't hold our feet to the fire on anything that we're going to tell you in this earnings call, at this conference, and so on. Forward-looking statements, again, are meant to involve risks and uncertainties. You cannot give any forward-looking information. I can tell you that in the old days, you could sort of give hints on things. You do that now, and you're slapped with big fines. I have a few examples here. In the interest of time, I'm just going to give you this one. SEC sued AT&T this year for a violation of FD that was done in 2016. What happened? AT&T learned that the revenue was going to come in light. The CFO told the IR team to work the analysts, basically, because they didn't want the analysts to have their models such that when the earnings call came out, they would say that they missed the quarter. So what did they do? They worked the analysts down. The IR team had private conversations with 20 analysts and said that the consensus revenue numbers were lower among analysts. But the reality is they weren't lower. They were just telling them that everybody had lower numbers, so you should lower the numbers. So what did they do? They lowered the numbers, and when AT&T reported their numbers, they beat the numbers. So SEC now sued them for a breach of this, of Reg FD. I'm going to pass over these. These are some examples from several years ago where, again, FD was violated and where they told individual analysts something that they didn't tell all of their investor base and got in trouble for it. So in conclusion, I'd just like to say to you as CEOs, as members of the C-suite, you're building a long-term relationship and you're establishing your reputation. You're not making a transaction. You can't walk out of a meeting with an investor and say, okay, I nailed that one. I sort of put one over on somebody. That stuff is going to come back to bite you. You need to really think long-term. Take your lumps when they come because you have an opportunity to build a strong relationship going forward. You never think of these meetings as conversations. They're interviews, and you have to be prepared for them. You're a storyteller and a communicator in chief. You have a well-rehearsed script. You're focused on your takeaways. You avoid hype, and you be confident, and you be careful. And that concludes my speech for today. So I'll take questions if we have them. And I appreciate the time. And again, thank you to the Merage Institute for having me.
Bruce, that was a great presentation. Thank you so much. And let's actually get started with some questions on the message board. First, we have, can you talk about the advantages of your product on a call versus badmouth your competitors?
Okay, so can you talk about, you can always talk about the attributes of your product on an earnings call. You don't have to talk about it relative to a specific competitor. So in other words, you wouldn't say, my cloud offering has the following features and Snowflake or whoever you're going to try to knock doesn't have that. That's really, you have an opportunity on your earnings call to actually on your website to include a short web deck, a web presentation with your earnings slides. And you can also have something like a grid that shows how you compare to the competition without naming your competition. It's not really a good idea to get too deep in the weeds on an earnings call because everybody's got a lot of earnings calls. There may be 3 or 4 of them going on at the same time. The analyst that's following your company may have an associate on the call, so your analyst may not even be on the call directly. There are transcripts that are provided by your provider of the conference call. So everybody will get to see it. There will be a recording of your earnings call. It's just not a good idea to get too deep into the weeds because you're gonna put some investors to sleep, and it's just not a good look to really compare it to competitors. You have opportunities to do that one-on-one. After your earnings call, typically what you'll do is one-on-one phone calls or Zoom calls with your major shareholders and with your analysts, because your analysts are going to be the next morning or that night publishing their models, updating their numbers, coming out with any new product information or market developments that may be affecting your company. That will be an opportunity for you to get into more detail about your product. I hope that answered your question.
Thank you.
Then we have another question also. How many non-deal roadshows for a company that intends to register in NYSE? Also duration between the non-deal roadshows.
So if you've already like filed to go public, your bankers and your lawyers will tightly regulate what you can and cannot say, when you can say it, and who you can say it to. If you're not at that stage, but you're in sort of what I call the heavy marketing stage of your company, I think is personally a good idea, if you feel comfortable doing this, is to actually start providing some level of disclosure while you're a private company, because it's a good way for you to actually develop relationships with analysts and investors. You're not required to do this. It's just a way for you to start raising your visibility with this community, so that you're all of a sudden not coming on the scene just before you're ready to do your IPO. And but typically, non-deal roadshows for public companies, these are hosted by your brokerage firms that have coverage on you. So typically, if you're covered, let's say by Goldman Sachs, and they do a non-deal roadshow with you, you're typically going to do one of those in a quarter, and you may do the next quarter with Oppenheimer or with Morgan Stanley or with somebody else. They're typically one a quarter. If you're in high demand, you may have one with Goldman Sachs, let's say, and later in the quarter, but not too late in the quarter, because you'll be in a quiet period before you report your earnings, right? For probably a month before you report your earnings, you typically won't be doing any of these big disclosures on a non-deal roadshow. Many times you may not even be attending brokerage conferences, because you're in a so-called quiet period. And every company has a different definition of quiet period, which is really set by your board, which is set by your legal counsel inside and outside. Companies I've worked for in the past, for the month before, you're typically very, very quiet, because if you're at a brokerage conference on a Zoom, for instance, and you say things that you can't take back, and some investors have interpreted as a clue to what your earnings is going to be, and it's published and people trade on it, you could get into hot water pretty quickly. So non-deal roadshows for non-public companies, you can do more than one a quarter. That's really just a matter of how much exposure you want or overexposure you're concerned about. For public companies, they're typically one a quarter, two probably max.
Thank you.
We have time for just a few more questions, if anyone wants to open their mic or again submit on the message board. All right, last call for questions.
Just to say thank you.
Okay, thank you very much for the opportunity, and good luck.
Bruce, on behalf of Paul Merage and the Merage Institute, we highly appreciate you taking the time to enlighten our Merage tribe today. Thank you very much.
Thank you.
Bye-bye.
Thank you very much.